Over the years, I've been continuing to invest in a closed-end fund that offers a significant monthly distribution, despite some uncertainties it's currently facing. PDI, the PIMCO Dynamic Income Fund, is a fund that offers a lot of extremely attractive features for people seeking high income like myself. It offers a high yield that exceeds 14%, and again, it pays monthly distributions. What's also really impressive is that it's never gone through a dividend cut. In its 13-year history, PDI has continued to pay a consistent distribution with no reductions and the occasional special dividend. This fund has also delivered a couple of increases in their monthly distributions as well. However, since 2021, this closed-end fund has been facing some uncertainties. Its share price has struggled to recover to its pre-pandemic level, which was over $32 a share back in early 2020. Its dividend hasn't increased in 9 years, and it hasn't paid a special dividend since 2022. Most notably, however, is that its net asset value has struggled to regain its value, and it's continued to slowly go down over the past couple of years. With PIMCO cutting dividends on 2 of their funds earlier in the year, people continue to monitor the performance of PDI and whether its dividend could be next on the chopping block. In this video, we'll take a look at the Dynamic Income Fund and try and determine its health and what it'll take for this investment to start flourishing again. For starters, when comparing this fund to some of the others by PIMCO, we'll see that PDI holds investments that are higher risk than many of their other funds. According to its description, this fund will normally invest at least 25% of its total assets in privately issued, also known as non-agency, mortgage-related securities. The fund may normally invest up to 40% of its total assets in securities of issuers economically tied to emerging market countries. Non-agency MBSs are pools of mortgage investments that aren't backed by any government-sponsored enterprise. During the 2008 financial crisis, there were a handful of mortgage REITs that invested a lot of money into these non-agency MBSs, and practically all of them went bankrupt. Nowadays, most MREITs and other investment funds like this prefer holding agency MBSs because they offer a lot more safety. But obviously, the safer the investment, the lower the yield it's going to offer. Non-agency investments offer higher yields, but they also face a higher default risk when the economy is taking a hit. Emerging markets are another higher risk asset class. These markets usually don't have the same standards and regulations as US markets, on top of these emerging market companies usually being riskier themselves. So then, what's the key to picking safer MBSs and emerging market investments? It's to make sure that you have a really solid team when it comes to picking good investments and analyzing them to go into PDI. As I regularly have to highlight though, we oftentimes just have to put our faith into PIMCO and their team. Because when we pull up a list of all of the holdings inside this fund, and this is the case for many other PIMCO funds, we can see why people refer to this investment as being a black box. Just by doing a quick scan of the holdings inside of this closed-end fund, we can see sovereign bonds, reverse repurchase agreements, OTC swap agreements, currency contracts, and other non-publicly traded investments. It would be impossible to perform your own analysis on every investment inside of PDI, as nobody could be an expert in all of these areas or just have the time. There isn't a single person watching this video right now that knows a lot about Mongolian government bonds, French industrial notes, and corporate reverse repurchase agreements, which are all inside of this fund. Especially with these non-public companies whose bonds are held by the CEF. We have no way of knowing how these companies are currently performing and whether it would be a good idea to consider them. But many of their investment vehicles have kept performing really well over time, continuing to provide consistent income. One thing that is important with closed-end funds is to check the source of its distributions. It's common knowledge that with these specific investments, that if they're relying on a lot of return of capital for a sizable portion of their distributions, that's a really bad sign. The reason that's not good is because, unless the fund is using an option strategy, which does allow them to classify some of their dividends as ROC, then it's relying on paying out the capital that's already inside of the fund. When that happens, the fund is basically eating itself just to pay its distributions, and if it's happening a lot, then it's always going to result in massive share price declines over time. When we look at PDI's dividend history, none of the dividends are classified as return of capital. Normally, that's a good sign, but now here's a caveat that exists with these PIMCO funds. In January, their Strategic Income Fund, ticker RCS, went through a dividend cut, and this fund didn't report any ROC in their distributions leading up to that cut. So with these PIMCO closed-end funds, that doesn't always appear to be a good indicator as to whether or not a dividend cut is possible. And this is unlike the vast majority of closed-end funds that exist. Instead, what happened in January was when these cuts did occur, they happened to the two PIMCO funds that were trading at the largest premiums. RCS, for example, was trading at a near 80% premium right before the dividend was cut, and PCM was around 40%, which was the other fund that got its dividend reduced. Although PDI is trading at a premium right now, the good news is that it's nowhere near as high as other PIMCO funds. CEFconnect.com is reporting an 11.42% premium, which is lower than its historic average and quite a bit less than its 52-week high. Another thing to point out is that PDI uses a lot of leverage. It's not the highest that I've seen from PIMCO, but with an effective leverage of 30.63%, it's really high for CEF standards. For comparison, PTWise is currently 9.23%, significantly lower than the Dynamic Income Fund. So what's it ultimately going to take for PDI to recover in share price? The obvious answer, since this is a closed-end fund, is for its NAV to recover. And the only way that that's going to happen, at least fairly quickly, is for interest rates to get cut. This fund is overwhelmingly made up of fixed income investments, aka bonds. When interest rates rise, bonds become less appealing to investors, and as a result, people exit out of the bond market. When this happens, this causes the value of these fixed income assets to decrease in value. When interest rates are cut, then it lowers the federal funds rate, and that's when people start pouring their money back into these investments, raising their values. It didn't help that 2022 was literally the worst year for the US bond market in recorded history, and the NAV and share price performance of PDI clearly reflects that. But the good news is that the Feds just had their June meeting last week, and Jerome Powell again stated that they do intend to cut interest rates twice this year. All of the indicators show that inflation is still cooling off, and they'll hopefully follow through on those interest rate cuts in 2025. How drastic the cuts will be are completely up to speculation, but they'll probably be pretty small. Still, even the smallest cut should result in these pooled investments that are very bond-heavy rising in share price along with other companies that borrow money as part of their strategies. As I like to show people with these high-yielding investments, even when taking PDI's collapsing share price into account, it's still delivered an excellent return over the past 13 years. Since PDI's inception in 2013, it's delivered a total return of 275.01%, which averages out to 10.65% per year. A $10,000 investment back then would now be worth $37,519 today if you reinvested all of your dividends. Originally collecting $69.91 a month, if you had never invested another penny, again besides the dividends being reinvested, you would now be making $441.66 a month. If PDI doesn't get its distribution cut, and if we do get 1 or 2 interest rate cuts this year, then imagine what an investor's total return will be after PDI climbs in share price again. Ultimately, based upon all the evidence that we have before us, I don't see any red flags that would indicate that a dividend cut is coming. PDI doesn't have the same characteristics as RCS and PCM had when they went through their cuts. However, the inability to predict when a dividend cut is going to happen makes PDI a riskier investment. Considering we've been in our current interest rate environment for years, which hopefully will come to an end soon, and there still hasn't been a cut, I think it's a really good sign that hopefully it'll continue. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.